If you were to say, okay, the inflation target is 2% core, and they've been missing that for 7 years now, for example, well, how would that change anything that they're doing today?
It may not change what they're doing today, but what it would do is it would make the Fed effectively more transparent, and it would cause less volatility. There wouldn't be communication snafus like there was last year. So to the extent the Fed would be more clear, and we knew what it was following, and it explained when it missed its targets why, there'd be more accountability, and arguably term premium would be less, rates would be lower, and that'd be good for financial assets.
One more thing on this before I ask Craig to weigh in, but if it were a simple, let's say, inflation-based rule, and we're, again, just taking kind of the closest they are to that right now, 2% on the core, we've been missing that for years, that argues, and I think this is why the vice president was arguing for this, for the Fed to be stimulating the economy to raise inflation to 2%. So it's a more sort of sophisticated way of saying what the president wants. The president wants rate cuts. The vice president said the same thing, is saying that inflation should be the only target, just a different way of getting to that outcome.
Possibly, but you could also say, look, we weren't at full employment because we're finding the job market still generating very strong gains that many economists didn't think were feasible. So you could argue that one of the reasons inflation hasn't gotten to target is that we're not at full employment. So therefore, that itself means you should try to foster faster growth to give you higher inflation. So there's a couple different ways to get at it. But the other thing, Kelly, is that a lot of this inflation is global.
Yeah, it's not inconsistent right now because nobody's out there arguing we're at full employment, even though the rate is so great, because they say there's still plenty of slack. All right, let me get Craig to weigh in here. Mr. Callahan, from an investor's point of view, what's the most important thing to you about this Fed discussion?
Well, first, I agree that the Fed went too far last fall. I think that Fed funds and Treasury bills should be at 2%, right in line with inflation. So I agree with Vice President Pence on that. I disagree on the dual mandate. If it ain't broke, don't fix it. The Fed has engineered inflation dropping from 15% in 1981 to 2%, and unemployment from 10% down to 3.6%. So the Fed thinks they've done a great job, and I'd see no reason to change their mandate.
But you're just saying they made a mistake last year. Would a single mandate have helped avoid that mistake? Because if they didn't have 2% inflation, then they probably wouldn't have raised 4 times.
The European Central Bank has a single mandate, and look where they are. We're in much better shape than they are, and we've handled this last decade much better.
Okay, so you don't. So, Joe, quickly, you were going to say something about how we do have a global problem when it comes to inflation, and maybe that's part of why the Fed has struggled to get to its target.
Right. And I mean, also the ECB, for what it's worth, has a single mandate, and they raised rates in July of 11, which is a big mistake. So again, we think we want policy flexibility. But I would argue, worry about the dual mandate. Inflation's low, inflation break-evens have fallen, forward rates have declined, expectations on the survey side are weak. The Fed can cut rates just because inflation looks like it might be weakening at some point. So you can have a good economy and still cut rates and not have to do anything with the dual mandate.
Right, but it's so rare for that to happen. And Craig, you're such a thoughtful guy. It's interesting to hear someone like yourself arguing for saying, look, the Fed made a mistake last year. The interest rate should be lower now than it is. So it sounds like you would be fine with them cutting rates, even though it'd be almost unprecedented, wouldn't it? Does it risk the chance of overheating these markets, which I know would be the last thing you want?
We don't see risk of overheating. In my view, risk-free investing, which are Treasury bills, should equal the inflation rate. In other words, if an investor doesn't take any risk, he or she should not gain on inflation. So that's my reasoning for a 2% Treasury bill, right in line with inflation.